Hey guys, welcome back to the channel. I hope everyone is doing well. So today I'm going to answer some reader questions that I thought might be beneficial to like the whole group as well. And when I say group, I mean like just the overall subscriber base. So I like to help subscribers, but keep in mind I'm not a financial advisor and I'm not one of those social traders. And I just want to say to this particular person, this is not uh, directed at you uh, personally. This is just like a general statement. I would say to everybody, even non-subscribers, don't be influenced. No one has the magic solution. And this person, I think they're trying to get some help in terms of how to direct like their funds. And I was trying to like answer this in as nice a way as I could. Do you hold any Defiance ETFs, and how do you feel about the minimal to no capital appreciation with them? Which ETFs do you use to gain capital appreciation with? And this person has concern about TRES, the new Treasury Defiance ETF. Has been pretty volatile day to day, so I'm not sure I'm even gonna buy any of that one. And that's fine. If you don't, if you're not comfortable or anything, you don't have to feel pressure to buy anything. And definitely, if you don't understand it, then definitely stay away in general. Uh, and I just want to disclose this carefully. I do hold Defiance ETFs, except for TRES, as of this recording. I do have a mix of stocks, regular ETFs, and crypto-related assets for overall portfolio capital appreciation. And the reason why I'm a little even hesitant to mention that, I you'll notice that I'm like very guarded about just like my own personal trading, and there's a important reason for that. But let's just try to answer this question a little bit more thoughtfully. So I think if you're concerned about like uh, like the capital depreciation, uh, others, including Jay Pastorelli himself, he suggests, well, reinvest a portion of your distribution back into ETF. You want to, I guess, like if you have like a certain amount of money that you want to put to work, you may want to consider that dollar cost averaging over time and using a portion of it to kind of, I guess, like reset your like your capital base. And then there are other people that are even more uh, I don't actually condone this myself. I only use leverage on like very special situations. But I guess if you're using like a low amount of leverage, I guess that's fine. And again, that's more of a personal decision too. As for myself, I like to wait for NAV discounts, and but that unfortunately will take time. So it depends on your own personality and what you're comfortable with. I know these are very vaguish answers, but again, I don't like giving away my positions or my allocations. First, I don't want to shill. Number two, I don't want to cause overcrowding because people have a bad habit of like whenever like bigger or more popular YouTubers that are also in the space, you'll notice like that a few days after like their video, like people will just crowd into like the ETFs, and you can see by like the number of shares outstanding and like the also like the price appreciation. But that's bad because like you're you're not paying attention to what you're paying for. So again, I just want to reiterate, this is not directed to anyone in particular, but this is just like more, please don't expect like any portfolio reveals going forward. This is not a trading service or a copy trading or anything like that. I bust my behind for my own like personal investing and trading profits, and then want and I actually expect subscribers to do the same. Don't go blabbing about your positions because otherwise, like then you might wind up diluting yourself. So and then I guess also to like answer if the person's maybe like the goal is maybe more capital appreciation. And again, this is just more of a generic opinion. You want to go find like the most liquid ETFs with like the deep option chains so that you can kind of lower your overall cost basis, either with covered calls or cash secured puts or some combination of the two. So for example, like SPY, Triple Q, IWM, those are kind of like the big guys. and then also TLT, like if you're looking for like a bond exposure, and in general, like if you're looking to put money over work for like a long periods of time, then there's nothing wrong with like good old fashioned dollar cost averaging. And again, I think you have to be clear on what you really want. If do you want like income to help pay bills, or do you want like the income ETFs to help maybe supplement your like your work or whatever, or do you want like and these are very personal decisions. Like it depends on like your age and how like when do you want to retire exactly. So I think you have to kind of figure some of these things out on your own because there's no way for me to know exactly your situation. And again, just to like as a very general, I guess opinion, you may want to consider like capital appreciation of that to offset like NAV depreciation and high yield ETF. Maybe is that the concern? So depending on your account size, you may be able to use like the high yield distributions instead of reinvesting back into like the ETF itself. And there's a typo here, sorry about that. You may want to like use like the distribution to fund the purchase of like a corresponding like the regular ETF. So let's say like you have IWMY, but then you're concerned about like maybe like a the gradual like I guess slide in the ETF like share price. You may want to like take some of that and buy like a few shares of IWM, like the regular IWM, like over time. That might help you offset some of like the capital depreciation. And then also like of course like you also have to take into consideration like how much pain can you take. So I think for most people, like the only way to know is to kind of experiment with your own appreciation to income ratio. So, for example, you may want to like look at 80% like triple QY to 20% triple QY. But I hope I said that right. So basically, like 80% triple Q, like the regular ETF, to 20% triple QY. If you're like maybe on the younger side and you can like ride out like some of the volatility, but if can like this might cause like some pain just because like triple Q could be like very volatile at certain times of the year, and then like some of the income from triple QY can help offset some of like the price shocks, or like the other end of the spectrum. Let's say maybe you're on the older side and you think, well, I don't want to expose myself to like that much price volatility. You may want to consider something like 20% triple Q, like regular triple Q, to 80% triple QY. But again, like on the opposite side, this might bore you to tears. So I guess like everybody has to find like their own like balance for themselves. And then the next question, I is regarding correlation. So this person is wondering where you get like the correlation numbers and what it actually measures. So this is coming from the Thinkorswim platform. I think most brokerages should have like some version of this too, but I don't know what platform you're using. So you may want to like look around. Um, so basically, this like to me, the way I like to think about this is like a measure of diversification. So basically, the number should be between 1 and -1, and of course, like you have to always keep in mind like these figures like change over time. So basically, if you want diversification, you want things with as low as a correlation as you can get. So hopefully that answers this person's question. And then this person, let's see, last of this is over my head. I think if you can do a a side by side comparison and show us me what would be the best scenario. And I kind of wondering what this person was referring to. I'm guessing this is in regards to dispersion. So think of this as basically a arbitrage trade. So let's look at like kind of back in the old days, like when the indices were first being constructed and like all the different ETFs. So back in the, I guess like the old days, like the arbitrage, this is based off of price. So basically the way to explain this like is like you want to look at which is overvalued. So let's say for example, the index, let's say SPX the SPY ETF, which is based on the XPX. So let's say you notice like the relationship between like the whole and like the different parts. So in the index, like it's going to be based off of like the 500 like underlying stocks. So basically, if you see like the uh, let's say for example like the SPX, you know it's should only be worth like 5,000. But then if you add up like all the weights of like the individual stocks, then you notice like wait a minute, it's like if I add everything up, it's only 4,900. Then you have a potential arbitrage opportunity. So basically, you would short the index and then you would buy like the individual stocks, and the difference between the two would be your profits. Or you notice like maybe it's the opposite. Well, like the index is 4,800, but then like all the if you add up all the stocks, and this is like then you notice that wait a minute, the sum of all the stocks is 5,200. So then you would sell the total of like the individual stocks, and then less your cost of like buying the index, and that's your profit. Now keep in mind this is a very oversimplified version of what actually happens, and of course like these are just like made up numbers. But this is just to give you an idea of what actually goes on behind the scenes with a lot of these um, like specialized hedge funds and like quantitative funds. And of course, like the in real life, like the profits aren't like this huge. Like so basically, like for a retail trader, you're not going to be able to really do much. Like unless you have like a really large like account size, and even then, this is very hard to do. Like even if you have like the most powerful computers and you have like a team of like analysts like looking at this all day, like it's still very hard and it's very like a competitive game. But this is basically what happens. And of course, like this is kind of like the old timey version. So a slightly more updated version of this is just another type of arbitrage. So basically for this version, it's based off of volatility. So again, like using the same concept, like you want to figure out like which is overvalued, and instead of like the price, you want to concentrate on like the actual volatility. So again, so let's say you notice like the SPX, like the indices, you notice the volatility is 45%, but then like you notice that the sum of like the weighted average of all the individual stocks, like the volatility is only 14%. Then well, there's a big arbitrage opportunity here, and like you would sell the index the volatility this time like at 45%, and then you could go long like the individual like stocks because it's 14%. And again, these are very exaggerated numbers, but this is just for like illustration purposes. So then you can make the difference between the two, and that should would be like your, I guess like the bigger funds, like that's their profit. And of course, like there is the opposite side of that. Let's say you notice like the index is like the volatility is only 10%, but then you notice if you sum up all like the weighted average of like all the individual stock volatilities, and it's like 38%, well then you would go long on the index volatility and short uh like the individual stock volatilities. Again, in practice, this is extremely hard. Even if you're smart and you have a large account size, this is very difficult to do. But, well, I don't want to give up like too much, but like there's a there might be a workaround for retail investors. And I kind of hesitate to mention this, but well, think about this. Like we have like these like high yield ETFs that are based off of like the indices, and then you also have volatility uh, ETFs that are based off of individual stocks. So I'll let you guys like draw your own conclusion. So I guess like the pros of like the overall high yield ETF space is that I think a lot of people are maybe like they feel disgruntled for some reason. But keep in mind, there's a lot of high yield goodies like coming out. So by the time this video comes out, like OT might be out, MSTY will probably be out, and then like after that, then it'll probably be like the inverse ETFs, and then whatever like the specialized individual stock ETFs from YieldMax, and then there's also like the stuff coming out for Defiance with like like the weekly short puts and like some of the like different indices like gold and TLT, etc. And then there's also themes ETFs. So there's a lot of goodies coming. So I ex- I guess like make up your own mind. But of course, like you want to maybe round this out with like treasuries, different aristocrats, etc. So of course, like the risk on like the high yield space is that like the expense ratios are kind of high, and we don't have any control over the option strike selection, and implied volatility could collapse. Although I would say that there could be some arbitrage opportunities. Again, pay attention to the space and learn more about these things. And of course, like the prices can get cheaper. Yields won't be consistent month to month, and you can't borrow against them yet. And then also keep in mind that I probably won't be around forever, like to the general public. So if you can, you know, like and subscribe and share and all that kind of good stuff, maybe we can keep like the channel going for a little bit longer. So you know, um, well, it might be bad news for me, but it could be good news for like the overall space. So thank you for watching as always, and I'll see you in the next one, hopefully. Bye now.